As you all have been aware by now, the crypto market is one of the most volatile financial platforms in both the physical and digital world. You can have a seemingly unknown crypto explode overnight, rising from less than $1 each to two-digit values. There are even cases where coins or tokens have seen rises of up to 26,000% in little less than a year, a relatively short span of time and relatively unheard of in the fiat markets. These spikes, or pumps, as the crypto community calls them, gave rise to hundreds, if not thousands of new millionaires around the world. But what makes it volatile is that all these could drop just as fast as they have risen. There are schemes that further the distrust of the crypto community, and even more so to those that are yet to engage in the cryptocurrency movement. There are cases where crypto that is steadily growing in value plunges to near zero in value, causing billions in damages and lost assets of the unlucky investors or users of the said crypto. There are measures and recommended practices that are made to combat these types of events and other illicit practices in the community. But even without all that, the sheer number of factors that may affect a crypto's value keeps the market as volatile still. Because of this, companies, developers, and traders had to develop or adapt multiple trading practices to keep the success that crypto has amassed through the years, to help make it to the future and be the stepping stone of humankind toward a more technologically inclined and overall advanced society. Welcome to our channel, where we show you all the latest, relevant, and any information that has to do or affects the world of cryptocurrencies, all in the comfort of your very own crypto addict. Today, we will be looking into one of the ingenious crypto trading practices, burning and buyback. We will also be covering its effects on cryptocurrency and the market as a whole. Before anything else though, please remember that this video is not any form of financial advice but solely our fact-based opinion that is meant to educate and inform you of the latest and most relevant information fresh from the world of cryptocurrencies. We strongly urge you to do your own research first before dealing, trading, or buying any cryptocurrencies, because knowledge is your greatest asset. Invest in it first. Before going into the actual burning and buyback processes, it's empirical to understand the importance of crypto burning and buybacks and their origins. For decades, buybacks, or share repurchase as it is more commonly referred to in the traditional financial market, has been a leading device or scheme that companies use to help them control and stabilize the value of their stocks. In its early year and even up to recent years, there are many instances of this practice being called out, as it can lead into very bad cases of price and market manipulation before it was regulated by the SEC back in the early 80s, which was amended in 2003 for stricter and more detail-oriented processes for companies to qualify for stock repurchase. Going back to crypto, the whole success of the community and whole crypto markets was largely due to its assimilation and implementation of traditional financial strategies into every part of its system. The flexibility of crypto, however, and the lack of an overall regulatory body to oversee trading practices done within the community allowed it to turn these practices into something that is a somewhat similar yet completely different tool, unique to the crypto community. Cryptocurrencies have been subject to volatile price movements and escalating competitive dynamics from competing tokens. This is among the primary factors that blockchain-based companies have initiated using buybacks and token burns as methods to boost prices and manage emissions. Although both ideas have the same intent, they are different in terms of how they work and how they want to affect prices. That leads us to the question, what exactly are crypto burn and buybacks? The terms crypto buyback and burn relate to the process of businesses purchasing their assets back from the market before extinguishing these said assets. Now, you might be puzzled by this at first, but by doing this, the total amount of tokens in existence is decreased, which raises the value of the tokens. To put it another way, this method serves to raise the worth and therefore the value of a specific token. It's advantageous for everyone because token holders get to watch the valuation of their personal tokens rise. It is also important to note that the first significant company with a large enough influence to incorporate this practice in the cryptoverse was one of its leading exchanges, Binance. When it happened, Binance used a staggering 20% of its profits to initiate and complete the process of buying back and burning their native BNB tokens, which was one of the most profitable moves the company made as it increased the value of BNB tokens in the market, therefore increasing the value of the company as well. Since then, additional exchanges like Huobi, OKX, and KuCoin have embraced the approach. With the implementation of their respective repurchase and burn strategies, each of these businesses had excellent outcomes. Now we'll show you how these practices actually work. Let's start with burning. Blockchain technology utilizes what's called proof of burn or POB. It is used to make sure that the actual and authentic condition of the blockchain network is acknowledged by all involved nodes. A group of protocols known as a consensus mechanism uses numerous verifiers to concur that a transaction is valid. POB is frequently referred to as an energy-efficient proof-of-work technology. It works on the premise that tokens for virtual currency can be burned by miners. The ability to write blocks, or mine them, is subsequently handed to them in accordance with the amount of coins burned. The tokens are sent to a burner address by the miners to be burned. Apart from the energy necessary to mine the coins before burning them, this technique doesn't use up a lot of resources and keeps the network responsive. You may burn either the local currency or the currency of an alternative chain, like Bitcoin, relying on the application. You're rewarded with a payment in the blockchain's native currency token in return. But because there are fewer resources and fewer competitors, the proof of burn protocol also lowers the available amount of tokens in circulation together with the number of miners. This might give great miners an advantage over smaller miners, allowing them to burn enormous numbers of tokens simultaneously, which would have an impact on the price and supply. A decay rate is typically used to avoid this centralization issue. As a result, the overall ability of each miner to validate transactions is reduced. Comparable to proof of stake, proof of burn requires miners to lock their assets in order to mine. In proof of stake, stakers can retrieve their coins once they have finished mining. But this is not feasible with proof of burn. The buyback procedure applies to cryptocurrencies as well. It entails buying community-provided tokens and depositing them in the developers' wallets. In contrast to burning coins, it doesn't get rid of the tokens for good. Both of these practices help the crypto community as a whole, as it is one way of attracting investors to engage in crypto markets. It is also more true at this current infancy stage of crypto, where almost everyone's confidence, especially for those who have yet to be initiated into the crypto community, is still low. Not only does these help attract investors, but they also support the growth of the market by capitalizing on the price stability that it creates. This results in an increase of cryptocurrency buybacks or burn liquidation, as demand always increases after either a burn or a buyback from the companies of said cryptos. Not all systems are perfect though, so there will always be risks involved. One danger is that an excess of tokens will be removed from circulation by the issuing business conducting the buyback. Any crypto dApp that depends on the specific coin can therefore quote-unquote run out of fuel. Also, there can be a chance that the token's valuation will decrease following the buyback. Investors end up with much less value than they did before this occurs. This typically happens when a team executes a repurchase that is smaller than expected. Yet, compared to the benefits that this technique generates, both of the aforementioned dangers are quite small. That is why crypto burning and buybacks became a de facto practice today, and the realm of cryptocurrency which runs it is the perfect place to execute both burn and buybacks, as they are run on blockchain technology which utilizes smart contracts that automatically execute predetermined actions when conditions are met. This not only gives each process a solid foundation, but it increases the trust and planning ability of future investors. All these increase the long-term growth of crypto as a whole. What other things or practices could you think of that could help further the growth of the crypto community as a whole, expediting success for everyone involved? It doesn't necessarily have to be something technical or any trade practices. So long as you think it could help the community, leave it down in the comment section and meet like-minded people. Though crypto burning and buybacks have indeed helped give stability to the crypto markets, there are still a ton of other factors that may affect the value of any cryptocurrency. So make sure to subscribe to our channel and hit the notification button so you won't miss out on any of our next videos, where we cover everything crypto and simplify it for you to absorb in the comfort of your very own crypto attic.